Stock market. All these things are related to currencies, and later on, or maybe in another presentation, I'll present the picture for the next 20 years and why it's important that you have a currency managed account, and why it's extremely important that you consider getting out of all long-only stock positions. If you have it for your retirement accounts, you want to be extremely careful in here, because this is getting close to a very major top, like 2000 and the year 2000 top, that may be of greater significance than the top of 2000 for many, many reasons I don't have time to go into. But here's a corrective move in the stock market. There's all sorts of Andrews lines of different degree we drew. 1, 2, 3, 4, 5. We're in a 5-wave top, and even this little wave, 1, 2, 3, 4, 5. Smaller momentum, smaller length than this wave 3. Again, 1, 2, 3 the biggest, 4, 5. Pulled back to the wave 4. This one pulls back to that wave 4 low. So now I would expect a little bounce and either pull back to 11,000 on the 1100 on the S&P, SPY, SP 500 trading stock, and possibly one more rally to this 1250 to 1300, or, and I'll wait to see what the lines look like at that point, or it breaks 1100 and hits 1,900, 650, and possibly going all the way to 450, or the 1987 low of 350, which would be we'd be in a major depression at that point, which is possible over the next 4 to 10 years. Here's the stock market since 1790, and you'll notice that there tends to be 20-year run-ups, or 20-year run-ups and 16-year run-ups and 20 years of flat to sideways. It's more or less 20 years up and 20 years down, or 20 years flat. We just finished 18, depending on when you count. If you count from the 1982 low, it's 18 years up. If you count from the 1974 low of 777 on the Dow, you know, we rallied up 24 years. But we're due for a major correction. And remember this, folks. Remember this. Whatever market you're looking at, I don't care if it's pork bellies, if it's Swiss francs, or if it's the stock market. If you're looking at a one-day chart on a 5-minute bar chart, if it corrects, if the market runs up for 2 hours, it's going to have a 45-minute pullback. If the market runs up for 70 years, it could have a 24-year pullback or a 35-year pullback. And whatever it is in life, when there's a big run-up, there's a big pullback. Corrections are always a percentage of the run-up. So am I expecting, you know, a pullback of biblical proportions? I don't know yet. I do eventually, and that's not a religious comment, but it's just a market comment. But I'm hopefully this is going to be a very significant pullback, but it's not, you know, the end of the markets. But we want to take advantage of it, and by having a currency portfolio and managed by someone that with tremendous experience will help you weather the storm, we want to have our funds, our different programs diversified. We have multiple strategies that diversifies our program. We want to have our funds deposited in dollars at certain times, in euros or other currencies at certain times. We're here to protect our own assets, our client assets, and to ride out the next 20 years in comfort. Why is this a real dangerous time in the United States history and the global history? Is, you know, the gigantic debt load we have. Here's a chart from Gabelli Associates. Our total debt to GDP right now is over 300%, and it's currently at 6.25 or 6.4 of total GDP, which is a place when other currencies have crashed. You know, like the Asian currency crash, the Argentinian peso crash, etc. So sometime in the next 2 years or 4 years, I expect that the dollar will crash, and whether it goes down to 60 or goes down to 40 or just goes into infinity, you know, abyss, nosedive, and you know. I do expect a major problem in the dollar after some kind of rally here. So, you know, stay posted and keep in touch with Dan and Henry. Here's what the cyclical composite chart that we have access to now. We're just getting all the technology. By the way, our system, our predictive overlay, uses cycles and extrapolates the cycles like 25 bars into the future. But pretty soon we're going to be able to do this hundreds of years, literally, let's say 100 years into the future. But this is take a 16-cycle composite of the stock market going back to the 1700s. And you'll see that every significant high and low in this stock market was forecasted by the combination and the composite of these cycles. What's important is the 2000 high was a composite of the 12-year cycle, the 32-year cycle, the 42-year cycle, the 34-year cycle, 42-year cycle, and now we're in a down mode. We're in a strong down mode, and it's likely that we'll be in a strong down mode until 2014, possibly 2016. Why? There's many factors, including demographics, including the fact that the U.S. government's going to have to start paying people, a tremendous amount of people, retirement benefits, and in 2014, people are going to be forced, the bulk, the median of baby boomers that are going to turn like 70 or something, and they're going to be forced to take their mandatory retirement benefits and draw off their 401ks and their IRAs. Probably the market's going to be tanked before that time, and that's just going to be the final bucket where people are forced to take money out, and that will probably cause a low in the stock market around that time, a major low. The Japanese stock market topped in 1989, and I'm sorry I don't have that chart. Our market is running at a 90% correlation to the Japanese stock market, which means to you that the top in 89, the Japanese stock market, just made a 14-year low or 15-year low, 14-year low in 1993, and we are going to make a 14-year low in 2014, and they're still, after 14 years, I think the highest they rallied was 40% or 50% of their old high. After this, it was less than that, 50% bottom. So I think at some time you're going to be looking back, and maybe 15, 20 years, and the stock market still hasn't made a new high, and is significantly lower than it is right now. I mean that with all sincerity. So please protect yourself.